All right, ladies and gentlemen, this is Aaron Fragnito with People's Capital Group here. Thank you so much for joining our webinar to speak about this new acquisition for PCG Fund 4 LLC, which is acquiring a 78-unit apartment building located in Beach Street in Hackensack, New Jersey. Love this location next to the #1 hospital in New Jersey and a nice Class C value-add apartment building we're going to reposition into a Class B, which we've been doing to help investors build their wealth over the last decade here in northern New Jersey with our vertically integrated real estate investment firm. So let's get right into it. Quick disclaimer here, this is not solicitation for funds for non-accredited investors. This opportunity is available only to accredited investors. This is a Reg D 506C, and this is available to accredited investors only. We'll go over that definition towards the end of the presentation here. Here's a quick summary of what we'll go over today. This will be about a 45-minute presentation, and we'll talk about the Fund 4 acquisition here. We'll dig into the numbers, go into the details, the structure and the financials. We'll talk about People's Capital Group and our past performance, our investment thesis, why we've been helping people build and preserve their wealth in northern New Jersey real estate over the last decade here, why we select northern New Jersey at all to focus on as a market, and how we find success here for our investors. We'll just take into some case studies in our current real estate portfolio to give viewers here an idea of what we're currently performing for our investor base here in the northern New Jersey market. So Seth Martinez and I started People's Capital Group in 2013 to help private investors build and preserve their wealth through bespoke real estate investment opportunities here in northern New Jersey. We're really a niche investment firm that focuses on just helping high net worth individuals, accredited investors, and family offices invest in very particular assets here in northern New Jersey, generally within an hour commute to Manhattan, at most a 90-minute commute into Manhattan here in the northern New Jersey market. And these buildings tend to be opportunistic value-add apartment buildings, meaning rents are below market value, they're mismanaged assets, but in high-demand locations, mostly occupied and cash flowing, but buildings that the units need to be renovated and the management overall the asset needs to be improved. Often vintage real estate, as we call it, meaning older assets that are in need of general renovations throughout, but still have good bones and have strong locations as well. So together, Seth and I have completed about 279 transactions in New Jersey together. We have an 83% reinvestment rate from our investors, meaning after a liquidity event, more than 8 out of 10 investors decide to reinvest with People's Capital Group. We have about 100 investors that invest with us, family offices, high net worth individuals, accredited investors. And our investors really enjoy this local experience here at People's Capital Group with monthly updates, quarterly financials, quarterly cash flow distributions, and annual K-1 tax returns we get out very promptly for our investors. So let's dig in now to our current opportunity here located in Hackensack, New Jersey. So People's Capital Group is offering qualified investors, accredited investors, an opportunity to passively invest in value-add apartment building located in high-growth northern New Jersey location, managed by our experienced in-house property management company. Here you can see the picture to the main picture here. To the left is the Meridian Hospital, the Hackensack University Hospital, voted #1 by U.S. World News for the last 4 to 5 years. To the right there is the other building. This is actually 239-unit properties, making 78 in total. And behind us, from where the picture's being taken, is the Hackensack High School. So this building is literally bordering the #1 high school. The parking lot in the back borders, the #1 hospital. And then, of course, across the street is the Hackensack High School. So that's one of the main things we love about this opportunity. Also, the rents are 50% below market value, meaning after renovation of a unit, when it becomes vacant, we can renovate the unit and bring the rent up to increase it by about 50% from the previous tenant. So that's a large amount of value add potential with this asset. And that's what allows us to drive greater revenue to our investors achieve a refinance and a sale with so two liquidity events along the way over this 5-year investment period. We do expect distributions to start from the first quarter of ownership. Distributions are completed on a quarterly basis, okay, every 3 months, and we expect them to start around 5% per year, then grow to around 6% by year 4 and 7% by year 5. So that's just the cash flow distributions on the asset. We also expect to complete a refinance on the building around the end of year 3, where we'll return about 30% of investors' capital on the refinance, and then a final sale of the asset into year 5, where investors should expect about 160% return or so on their investment. You could see here on the summary of returns, as I just mentioned, on a $100,000 investment, an investor would expect about $5,000 year 1, about $5,000 year 2, about $33,000 year 3 with the combination of that cash flow and the refinance, and then about $6,000 year 4, about $170,000 year 5. You can see the sale is the main driver of profit for this investment opportunity. And that's where most of the return on investment is realized on the sale of this investment. We also offer a better share class as well for investments over $500,000. You can see on the right, the returns are a little bit stronger targets for a larger investment. On the left would be the B class, which is a minimum investment of $50,000. But that's an example for a $100,000 investment in the B class. On the right is an example of $1 million investment in the C class, where the minimum investment is $1 million. $500,000. So a new and a proven approach to real estate investing. So here, People's Capital Group, we really focus on solving the multiple issues with the current real estate investment environment, and offer a proven solution for investors to build and preserve their wealth in the often overlooked yet high demand and undersupplied northern New Jersey market. See, most investment groups, syndication groups focus on the Sun Belt and red states. And we understand the reasons for that. There is strong growth in those areas, and there can be easier states to navigate the landlord environment. However, we have developed a very good process here and a good understanding of how to navigate the red tape of the New Jersey market and how to be a strong landlord for our investors and our tenants alike in the northern New Jersey market. We also find that the Sun Belt markets can be oversaturated. Areas where it's easier to develop, like Phoenix and Texas and so on, sometimes Florida and even the Carolinas, experience oversaturation in these markets more easily than markets where it's harder to develop, such as northern New Jersey. We also have a proven value add strategy here by purchasing discounted vintage older apartment buildings near New York City, but in New Jersey. And we reposition them, we improve the assets and lease them up for fair market value to create cash flow and liquidity events for our investors. And there's no shortage of older apartment buildings here in New Jersey. We're able to source those deals usually off market for a discounted price through our investor network. We have a lot of realtors that we've been working with for years, wholesalers, landlords, and we buy deals off market that no one else knows about. We're often the only bidder on the table. These aren't sitting on the internet. These are deals that we go direct to the broker. They're pocket listings before they're marketed out to hundreds or thousands of buyers. We get in there first, and we're able to lock these up for great prices and bring these discounted off-market deals to our private investor base and give them access to deals that they normally would have never had access to. We also do something called cash for keys. We're able to negotiate in rent-controlled markets, which is not all in North Jersey, but some rent-controlled markets. There is rent control in Hackensack, New Jersey, which we'll talk about in the next few slides. It's not that bad. It's not as restrictive as other markets, such as Jersey City or Hoboken, but there is rent control for this building. So we offer something called cash for keys to tenants, which is essentially a move-out incentive to encourage a tenant to move out upon their lease expiration, and that allows them to vacate the unit at which point the unit can go straight to fair market rent upon renovation. We don't have to go in front of the rent control board or anything like that. We can simply renovate the unit, improve it overall, and then lease the unit up for whatever the market is bearing without getting any approval from the rent control board, any requirements like that. So it is a little bit, there is 100% vacancy decontrol. That's what that's called here in Hackensack, which makes it a little bit of an easier market to navigate than some other North Jersey markets, such as Jersey City or Hoboken, which is harder to be a landlord in than Hackensack. We also are supplying an underserved market with an insatiable demand for housing and a shortage of supply here in northern New Jersey and many states, but especially New Jersey. People's Capital Group can lease renovated apartments for top rental prices throughout northern New Jersey. See, we underprice the Class A real estate, right? We're not competing with the brand new buildings that have pools and spas and higher amenities and brand new finishings. We are going to create units that have laundry in the unit, quartz countertops, recessed lighting, refinished floors, brand new bathrooms, and lease them for about 40% less than what Class A buildings will be leasing 1 and 2 bedroom units for. So we really serve a market of individuals earning between 80,000 to say 150,000 is our perfect demographic for our type of tenant. And there's no shortage of them working over at the Meridian Health Center, which is the rear of the property. Literally bordering this property is the largest hospital in New Jersey. I'm sorry, the #1 hospital in New Jersey. It employs about 7,000 people at that hospital. And then across the street is the Hackensack High School. So a good supply of a quality tenant base for our units there, very close to the building. Let's explain cash for keys and how that adds value into the building. So here's a good example of a tenant in this building on Beach Street that we're purchasing. Maybe they're currently paying about $1,500 a month, and the fair market rent of that renovated unit is $2,300 per month. That's a good assumption here. We expect to rent the 1 bedrooms for $2,300 a month, and a lot of these tenants are paying around $1,500 a month or so currently. So the difference in rent would be about $800 a month or $9,600 a year. Now, if the tenant moves out here for $10,000, let's say we offer a cash for keys of $10,000, and the renovation cost of that unit is $33,000. So in total, we're investing about $43,000 to vacate and renovate that unit. However, we're gaining a value of $160,000 because the annual difference of $9,600 a year divided by the capitalization rate of 6%, which is the market cap rate for this building, creates a value of $160,000. So that means an investment of $43,000 equals a growth of market value of $160,000. That leads to a net value creation of $117,000. So you can see clearly if this is done now 50 or 60 times over throughout the building, you could create a significant amount of wealth in this building and for our investors over time as we reposition this asset. Even if we only reposition, say, 60 to maybe a third of the building, 60 to 66% of the building or so, we can create a large amount of value add for our investors in this asset and bring this unit from a Class C up to a Class B building and allow our investors to have nice liquidity events upon the refinance and sale of the asset and increased cash flow distributions. Here's a little more about the strategic location of the building here. The Meridian Health Center, or the Hackensack University Hospital, as I was saying, literally borders the rear of the property, and there's the high school across the street, nice baseball fields and football field there. It's about a 12-minute drive to Manhattan, very close to Manhattan, 28-minute bus ride or 38-minute train ride to get into Manhattan. It's a 24-minute drive to the Newark International Airport, very strong airport there in the area. And U.S. News World Report voted the Meridian Health Center, the Hackensack University Hospital here, from 2022 to 2025, the #1 hospital in New Jersey. It employs about 7,100 people, and that's a great employment hub for our property here in Hackensack, New Jersey. Here is a picture of the second building. Again, these is two buildings on one lot with a large parking lot in the rear. 39 units in each building, 78 units in total. The landlord pays the heat, hot water. The tenants pay their own electric and cooking gas. You see here on the left, about 2/3 of the kitchens need a full renovation. That's kind of the older, outdated kitchen there on the left. And about 1/3 of the kitchens need a partial renovation. See on the right, it's not bad. Stainless steel appliances, nice granite countertops, nice dark cabinets, nice backsplash. So there'll be a much smaller renovation on those units. About the kitchen on the left will cost us about $12,000 or so to renovate. The kitchen on the right will be $1,000 to $3,000, just light renovations, if anything at all, really. Painting, maybe some recessed lighting. And again, about 2/3 of the bathrooms need a full renovation. Bathroom will be about $8,500, and about 1/3 of the units need a partial renovation. You'll see on the right there, in decent shape. That'll be more of like a $1,500 so renovation, just a light renovation, maybe some paint, recessed lighting. There's the parking lot in the back. It's not in bad shape. Maybe just a little patch, a little seal work, but nothing major. The whole lot itself is in good shape. To the left there, the parking lot picture, you'll see a parking garage. That is the parking garage for the Meridian Health Center. And this parking lot in the back, a lot of the leases don't charge for parking. Parking is very tough in this area of Hackensack. So this is a great amenity that we're, of course, going to incorporate into the leases for the tenant. And this will drive an additional stream of income to investors on the property and increase our revenue on the building as we renegotiate the leases upon renewal and work in a cost for parking here in the rear of the property. There are 75 parking spots in the rear of the property. One of the things we love about the asset is the size of the units. This was built in 1935. It's an older building. However, at that time, they made larger units with high ceilings and big open floor plans. So our one bedrooms are true one bedrooms with a living room, a big living room, big bedroom, and a nice sized eating kitchen. So they're very sizable units. They all have that kind of old fireplace mantle that's not in use, but it is a nice little touch there on the units, his and hers closets, and just a large size units throughout. A lot of the new construction you'll see today, sure, they'll have better amenities and nicer finishings, but they're generally smaller units than what we're offering here. And most of them don't actually have a living room and kitchen in separate rooms. They're a living room kitchen combo, and they tend to be smaller square feet. So we offer a true, a separate living room for our tenants, and a lot of them will say, you know what, I get a nice, a nice laundry in the units, renovated kitchens and baths, and a larger unit. I'd rather have that, even though it's in an older building, than perhaps paying 40 or 50% more and getting a smaller one-bedroom unit in a brand new building. A lot of tenants will say, I'll just get a gym. I'll just get a gym membership. I don't need a building with a gym in it. I don't need a spa in it, right? I don't need a pool in it. I can just sign up for the YMCA or something like that, or a local gym, and get those amenities separately and save a lot on rent. And that is the demographic we're seeking here. Hardwood floors throughout will be refinished upon turnover. In unit washer dryer. The main lobby, very plain, a plain canvas. We're going to update the lighting in there, put some nice couches and chairs and coffee tables, and make it a more inviting lobby for tenants and attract that higher, stronger demographic for our building here. And the first thing is with the lobby, as you walk in, what's the presentation you get? In this case, there's no area for packages to go. So packages just go anywhere. There's no furniture. It's not very inviting, right? And so of course you want to make a nice inviting lobby here in the building, and that's something we'll be doing with the renovation funds on this building. There's the building to the left. There's the high school. You can see high school is letting out there, the buses and the children walking about right across the street from the Hackensack High School. Of course, there's the main picture with the hospital to the back to the left there. Let's talk about taxes for a second. The new tax bill allows for a 50% tax write-off. So on a $100,000 investment, investors should expect about a $50,000 tax deduction for year 2025 to write off their passive gains. If you need to write off active gains, get in touch with our team. We do have a strategy to write off active gains with these passive tax write-offs. We can talk to you more about that, see if you qualify for that strategy there. But this is a beautiful thing with a new tax bill. Again, a $100,000 investment. You expect about a $50,000 tax write-off for 2025 and additional tax write-offs into the future as well. We do this through a cost segregation study. If you want to learn more about that, schedule a call with a member of our team. We'll talk to you about the tax benefits of this building and investing in real estate in general. All right, let's go through the structure and the financials for this investment. So at the top here, we have People's Capital Group. That's owned by Seth Martinez and I, and that is the managing member of the PCG GP Fund, which is fully funded. That's 80% limited partners, 20% general partners. That fund is fully funded at this time. And the PCG GP Fund will bring in the 20% GP investment for the PCG Fund 4. PCG Fund 4 LLC is managed by the GP Fund and the main fund investing in Beach Street Holdings, which will hold the asset. PCG Fund 4 is only investing in one property. It's this property on Beach Street in Hackensack, New Jersey. 20% of the capital will come from the GP Fund. 80% will come from limited partners. This is a total $7 million raise for the PCG Fund 4 LLC. There's 3.58 available to investors. That's filling up quickly with a minimum investment amount of $50,000. The entity itself will be held in Beach Street Holdings LLC. That's the operating entity. The rent goes into that entity. The expenses go out. And at the end of the quarter, any net positive distributions go up to PCG Fund 4, are distributed to the LPs and GPs. And of course, anything up to the GP level goes up to the PCG GP Fund LLC, out to the LPs and GPs in the GP Fund. So that's the structure here. What's available to LPs right now is PCG Fund 4, which is a single purpose entity designed strictly to invest in this one asset. And we are raising about $3.5 million from accredited investors for PCG Fund 4 LLC. Here's the two share classes. We have the B class, minimum $50,000 investment. That's a 7% preferred rate of return. Then it goes to a 70-30 waterfall split after that. We're targeting a 20 IRR, 2.2x equity multiple, 50% tax depreciation upon a 2025, a year of investment, and a 24% average annualized return on this investment. So for example, the target equity multiple 2.2x, that means on a $100,000 investment, you'd expect to walk away with about $220,000 over the life of the investment, the 5-year period. That's a combination of cash flow distributions, refinance distributions, and sale distributions. Class C, you're looking at a $500,000 minimum investment, 8% preferred rate of return, then an 80-20 split for the LPGP. Target IRR of 21% with a 2.3x equity multiple, 50% tax depreciation of 2025, and a 26% AAR target on that investment. So for example, on a $1 million investment, you'd expect to walk away with about $2.3 million on this asset for Class C. Here's the capital stack on the right. We have a bridge lender coming in with $12.6 million. They'll be taken out through the refinance at the end of year 3. We have a preferred equity investor coming in with $3.15 million into PCG Fund 4 LLC. They will also be taken out upon the refinance at the end of year 3 upon the building stabilization. Then we have the common equity for PCG Fund 4. That's where the investors listening to this webinar would be investing. That's a $3.58 million investment in total. And then we have the PCG GP Fund bringing in just under $900,000 for this investment, totaling about a $20.2 million capital raise for the building here. Here's the sources and uses, as we talked about. In total, a little slightly different than some of the numbers previously. The numbers are kind of always subject to change a little bit slightly here. We have the acquisition of the property of $14.9 million, closing costs of $927,000, legal pre-development $72,000. Reserves, a large amount of reserves, $1.3 million. That's for the bridge and the pref and for investor distributions. hard costs as well, and our distribution reserve there. Here is our T12 on the building here. If anyone would like a copy of this offering memorandum, you can access it in our deal room for this opportunity. You can also email us at info@peoplescapitalgroup.com, and we can send you a copy of this offering, or you can schedule a call with a member of our team, and they can email a copy of the deck here, the offering memorandum, to you after the call. Here's the pro forma for our net operating income. Again, I'm not going to really dig into this right now. If you'd like a copy of this offering, schedule a call with a member of our team. Here's the net operating income summary. We try to be very transparent. You can see the yield on cost starts around 4% in year one, grows to 5.8 by year two, 7.2 by year three, and grows up to 7.6 by year five. So you can see most of the stabilization and the growth in the asset is happening in the first 3 years. We expect to get to stabilization and reposition the asset over those first 3 years, and then move into long-term debt. We'll refinance into agency debt, most likely a Fannie Mae product, end of year three, taking out the bridge debt and the pref equity end of year three, and then holding on to the asset for 2 more years, growing rents, and then essentially selling into year five as well. Here's the rent roll. It's mostly 1 bedrooms with some 2 bedrooms. But the building is mostly large 1-bedroom units. We do find 1-bedroom units actually lease the fastest. And your price per square foot is a little better with 1 bedrooms as well. Sales comparables. So here's some comparable sales. The average sale price per unit is $217,000. We are paying $191,000 per unit. So we believe we're buying this property at a decent discounted price here in Hackensack, New Jersey, and that's where you make your money in real estate. You make your money when you buy. Here's the rent comparables as well. The average 1-bedroom rent is about $23.31 a month. The average 2-bedroom rent is about $26.75 per month. We had a rent study done, which I'll go over in a second. The rent study from our leasing staff came back at $23.50 for 1 beds, $27.50 for 2 beds. So we underwrote the building assuming $2,300 for 1 beds and $2,700 for 2 beds. It doesn't sound like a lot, taking off $50 per unit, but if you multiply that out over all the units in the building, it actually makes a very sizable difference. So we're being quite conservative on our rental assumptions. Again, this is after renovation with laundry in the unit, quartz countertops, recessed lighting, brand new kitchens and baths, updated lobby, and so on, improved management. We think $2,300 is very doable for the 1 beds, $2,700 for 2 beds. Our leasing staff thinks we'll get a little bit more, and hopefully we do. Here's the rent study. Again, if you want a copy of this offering memorandum, we can send that to you. Schedule a call with a member of our team. We can get this out to you quickly. Here's a disclosure on some of the fees here. We try to limit our fees and make most of our returns as a company here through performance on the equity side of the building. So we need to perform on the equity side. We also have some fees to cover our cost as well. 2% of the purchase price, most of which is rolled into the deal, is our acquisition fee. That's about $298,000. Again, about 70% of that or so is actually rolled into the deal as our equity in the opportunity. We have an assets under management fee, which is about 2% of effective gross income on the asset here. That comes out to about $40,000 a year. Again, we need to actually be collecting rent. Our assets under management fee is not a percentage of capital raised. It's a percentage of effective gross income. So we need to be renovating units, collecting rent, improving the asset, making the asset perform to collect our AUM fee on a monthly basis, which comes out to about roughly $3,300 a month or so. Underwriting, we have a third-party underwriting team. We have a very in-depth Excel model that we use to underwrite these assets. If you want to copy that model, schedule a call with a member of our team, and we'll get that out to you. It costs about $2,500 to have this property underwritten, and that's a fee we put up front, and we'll reimburse that at closing. Property management charges 3% of, again, effective gross income here for full service property management. You know, we shop around, we own our own management company, but we also look at what other property management companies are charging. First of all, if you ask most property management companies to negotiate cash for keys, renovate units, improve the common area, improve management, renew leases with charges for parking and storage and so on, put 50 to 60 storage units into the building, and improve the asset overall, most management companies are going to be like, no, that's okay. We like just managing service providers and calling a plumber when the pipes leak. This is a true repositioning company. So PCG Property Management, our in-house management company, is a real repositioning company. We do all of our bookkeeping in-house, property management. We do have third-party leasing companies and third-party contractors, and that's disclosed here in the disclosures. So a couple disclosures here. Distributions are return of capital, not a return on capital, and they're from the excess reserves during years 1 to 3. So that's good for tax purposes. You should not be taxed on distributions on this asset. All the money you're earning from this property is a return of capital. So until your entire basis is returned, your entire investment is returned, it's essentially non-taxable income on this building. 80% of the capital in the PCG GP fund is from LP investors, as explained in the previous slide. Leasing commissions is 1 month's rent and is paid to a third-party leasing agent. Essentially, we use a leasing team, a realtor, to lease these units. They're a great team that gets this done very effectively. Their fee is the first month's rent. It's paid right to them. It's not our team. It's a third-party service. The property is negative cash flow from years 1 to 3 as we're repositioning, as we're moving tenants out and renovating the units. We are using a fund. We're accruing additional reserves. We're raising additional reserves to distribute back to investors over the first 1 to 3 years on this investment. Here's the debt terms. Okay, we have a loan of bridge loan of about 85% of loan to cost, about an 8.5% interest rate. They will hold back about $500,000 interest reserves. Our pref equity is about $3.15 million. Their fee is 1 point upon closing and then 1 point upon exit. 7% current pay, 8% accrued. That's a total of 15% preferred rate of return, 0% equity participation. They are taken out upon the refinance. The permanent loan is about we're assuming 1.25 DSCR, just a Fannie Mae loan product, 75% LTV. We're assuming interest rates are what they are today. If we went and got a Fannie Mae loan on this property, we would be locking in about a 5.7% interest rate. So we assume when we go to refinance, interest rates are what they are today. Now, when we go to refinance, this will be almost 3 years from now. So hopefully rates are lower. If they're not, that's okay. We're assuming rates are what they are today, which are kind of elevated. And again, a 5.7% assumed interest rate is what we were quoted on this current building at this current time. Here's our exit assumptions. Again, we're paying $191 per unit going in here. Our going in cap rate is 4.7%. That's a very conservative cap rate. We are really expensing a lot from the building. If you ask the broker what the going in cap rate, he'd tell you it's around 6% because brokers conveniently forget a lot of expenses. When we underwrite a building, we pack the expenses. We know that expenses can be a lot. I'm managing, especially these older assets. So we recognize that we're coming in at a lower cap rate, but that's also a very conservative underwriting of the building. Again, a cap rate underwriting is very objective, and in this case, we have a lot of expenses, probably more than the average investor would use on this building, and that does lower your cap rate assumption there. Our reposition cash on cash grows to 6.4%. And our exit assumptions are that the market is what it is today. We are assuming this building, the market, when we go to sell it in 5 years, the market is what it is today. Interest rates are high, cap rates are high, prices are low. We're assuming a 6.2 exit cap rate on this building. That's about a $26 million valuation, or $333,000 per unit. We're assuming that the market is what it is today. Hopefully, we're exiting into a better market. Quite frankly, if cap rates drop to like 5.5 for this building or something like that, by year 3, we'll forego the refinance and go right to sale. You don't want to look a gift horse in the mouth, and hopefully over exceed targets to investors. If the market is not ripe for sale at year 3, we'll refinance, continue to grow the rents, and sell around year 5 for this asset. But we are assuming the market is what it is today on both our refinance assumptions and our sale assumptions. Here's our reserves on the building. We have a large reserve for the lender. Cash for keys, we're allocating $437,000. Hopefully we don't have to use that all. We're pretty good at negotiating cash for keys and not utilizing the full amount for it. Leasing cost reserves to lease up those units, a large contingency of $119,000. Very, very large reserves here. $25,000 for roof, $25,000 for mechanical, $88,000 for additional debt service. So large amount of reserves here for the property. And that's about $1.3 million in total operating reserves. We assume about 2/3 of the building will be turned over in the period of time we are doing our renovations. We're buying it with 5 vacant units, which we'll start renovations on right away and lease those up ASAP. And then we assume we'll turn over an additional about 60% of the building or so beyond those 5 vacant units. So that's our assumption for this building. We don't assume we're going to turn over all the units. We know that plenty of tenants will just accept the 5% max allowable rent increase year over year, which is the max allowable by rent control, and that's fine. But we do assume about 2/3 of the units will be turned over in the first 3 years of ownership. We're allocating an additional $830,000 in reserves to distribute to investors over the first 3 years. That'll be a return of capital to the investors. Here's our hard costs. Again, we could send a copy of this OM to you and the underwriting model if you want to schedule a call with a member of our team. We assume about a $2.1 million renovation budget on this asset here, and that allows for about $32,000 for full renovations of units. As you remember from the previous pictures, some units need a full renovation, some need less, and about $13,000 to $14,000 for the partial renovation of units. Here's our closing costs. We talked about the acquisition fee of 2%, title insurance, equity placement fee for broker-dealers or equity placement companies, the pref fees as well. Then your normal costs for the lender and appraisal, inspections, application fees, legal closing costs, loan processing, so on, escrow for insurance and property taxes, potentially credit for the green card also, and a contingency. So large amount of closing costs here for the asset. We always like to kind of overestimate this and ideally return money back to investors post-closing. Here's our deadline on this investment. We are asking investors to complete the investment by the end of July. If you're watching this after that, I'd encourage you to schedule a call with a member of our team because the spots may have all been filled up by now. We do work with investors on a first-come, first-served basis. The ultimate deadline being August 15th for investors to complete their investment. You can use a self-directed IRA or 1031 capital for this. To learn more about that process, again, schedule a call with a member of our team. We expect to complete our due diligence by July 30th, have our mortgage commitment around the middle of August, and closing beginning of September. Post-closing, we expect to start our quarterly distributions after the third quarter here. So interest accrues on invested capital prior to closing. In a high interest savings account with PNC Bank, we're getting about a 3.8 interest rate on that capital right now. So that is distributed out to investors. Distributions are completed about 4 weeks after the end of each quarter. So the first distribution should hit investors' accounts around the end of October to early November. March 15th, you expect your K1 tax forms. That'll be a 50% tax write-off for your 2025 tax year. So on a $100,000 investment, you expect about a $50,000 in tax depreciation for 2025. October 31st, 2028, we expect the refinance distribution. Then by the end of October 2030, we expect to be exiting the asset. Of course, timelines are subject to change here. Let's go over People's Capital Group executive summary here. So we have been in business for over 11 years. Seth and I have completed multiple transactions, almost 300 transactions in New Jersey here. Around 2019, we decided to focus on kind of quality over quantity and reposition larger apartment buildings. We've done a lot of fix and flips, wholesales, small and large multifamily properties, all focused on this North Jersey market here. And we have close relationships with industry leaders here that allow us to get market deals at great prices, experienced institutional level teams here in New Jersey, and an in-house property management company to keep tight control of these assets. Our average rent roll increase per year is 8.6%. Our average annualized cash on cash return to investors, including exits and refinances, 15.1%. We've completed 11 syndications, meaning we've raised capital and closed on an apartment building 11 times, and we have an 83% investor reinvestment rate after a liquidity event. Nearly a $40 million portfolio of assets here throughout New Jersey. 98% of our transactions are in New Jersey since inception. About 191 apartments at this time. We buy and sell apartment buildings continuously. 30 years of combined experience between Seth and I here and our property management firm. We've raised about $18.6 million and returned about $8.4 million to investors in total here throughout New Jersey over the last decade plus. We have about 32 properties, 99% occupancy rate for stabilized buildings. Our average cost per door purchase price $131. Our average realized sale price per door is $226, a nice delta there. Our average rental rates around $15.27. We own a lot of assets in Newark, Patterson, Passaic, Rahway, Jersey City, Bayonne, and all throughout northern New Jersey. Preservation of capital is one of our main goals here at People's Capital Group. We rigorously stress test each deal. We have an institutional level underwriting team. If you want a copy of our underwriting spreadsheet, you can email us at info@peoplescapitalgroup.com, or you can schedule a call with a member of our team. We also focus on returning capital. That's done through the refinance, in this case, into year 3, and also through the distributions as well that are completed on a quarterly basis. And then the return on investment, that's primarily realized the sale of the asset. That's the repositioning the building, increasing revenue, making it a nicer place to live for our tenants, making it a more valuable building for our investors, increasing the net operating income, and then harvesting that equity growth through time as we sell the building over a 5-year period. Our differential value add strategy here is really all about creating alpha generation here in the asset, creating forced equity into the building, buying the property at a great price off market with our skilled deal sourcing, vertical integration with in-house property management, having efficiencies of operations here, and an investor-first approach with our monthly updates, quarterly financials, extensive due diligence, getting K1s out on time. Our investors have a portal they can log into and get access to all these documents, all these updates, all these financials at any time, similar to an Ameritrade investment account or something like that. But instead of owning stocks, you're owning real estate. So it's completely passive, completely transparent investment opportunity here with People's Capital Group. We'll look at 100 deals to buy one. We do a quick review of about 100 opportunities. 30 will undergo serious due diligence with our underwriting team. We'll submit 10 to 20 letters of intent to have one offer accepted. Once an offer is accepted, we create a data room with all the offering documents and a full set of due diligence as well on the asset. You can get access to that data room by scheduling a call with our team. We have the subscription agreements and start collecting capital about 30 days prior to closing. Post-closing, investors should expect quarterly cash distributions, monthly and quarterly updates, quarterly financials, and annual K-1 tax forms. Here's our management team with me on the left, Seth on the right. I'm primarily in charge of client relations and capital raising. Seth is primarily in charge of operations, managing the management company and the capital management team. I'm more on the marketing, branding, deal structure, and reviewing the upcoming opportunities, raising the capital for them, structuring them wisely for our investor base. Once closed, Seth takes over on the operations and management side, managing our team to make sure our 5-year reposition strategy is executed in reality. There's me on the left, co-founder of People's Capital Group. Seth and I, again, have completed nearly 300 transactions together in New Jersey here. I actually started as a realtor and read a book called Rich Dad Poor Dad and realized my passion for owning real estate here in Northern New Jersey. I host the Passive Cash Flow podcast, the New Jersey Real Estate Network with about 5,000 members in it. Our podcast has about 190 episodes. I wrote and taught a course called Real Estate Entrepreneurship at Rowan University. Also graduated from there as well in 2009. Seth Martinez sold a medical billing company, had a nice liquidity event in 2009 as well. We teamed up in 2011, started realizing our strengths and weaknesses complemented each other, and bought our first property together, a 6-unit in Newark, New Jersey, through a We Buy Houses sign. We stapled 2 telephone pole for $220, put about $80,000 into it, refinanced all our money back out a year after we stabilized the asset. We still own that building to today. So that's when the light bulb went off, and we said, hey, if we continue to rinse and repeat this strategy and invite other investors in to participate with us, we can help a lot of people build wealth in real estate and succeed ourselves as well. Here's our investment thesis. Why New Jersey? Why don't we go to Texas or Carolina or Phoenix like every other real estate syndicator? Well, we find an inherent need for housing here within an hour commute to Manhattan, strong cash flow, declining home ownership rates and single family starts here in Northern New Jersey, a lot of tax advantages of real estate, a lot of capital appreciation as well. Real estate's in very high demand here, continues to grow in value, and a supply and demand imbalance. They're not building enough real estate in New Jersey. We're about 3,000 units short each year, some years even more, here in Northern New Jersey. Real estate's a hard asset. We like how you can protect your investment with the hard asset of real estate, insure against loss, and so on. Favorable demographic trends. New Jersey is a net immigration state inward. We have more people coming to New Jersey than leaving, despite what the media might say. We have population growth here in Northern New Jersey. A lot of people are moving out of New York City and into New Jersey to live in the suburbs here, get a better quality of life, better schools, and still enjoy the nightlife that North New Jersey and the restaurants and the entertainment we have here in Northern New Jersey. You can go skiing, you can go to the beach, you can go to the mountains, or you can go dancing in Hoboken all in one day here in Northern New Jersey. So favorable market pricing, liquidity, very high demand to own real estate here in this market. Properties sell very quickly. Units get leased up very quickly. A huge demand to own and rent here in this market. You can see home ownership costs, including financing, have skyrocketed in recent years here on this chart. Right around 2021, the cost to own a home outweighed the cost of rent. And if you're trying to buy a home right now, you'll see that. It is very expensive to own a home in Northern New Jersey. It's actually about 30% cheaper to rent a home. Therefore, we're seeing a lot more people rent property in Northern New Jersey than own. That's good for us landlords. It's been more affordable to rent than own since the end of 21 by a significant amount. You can see here on this chart, it's around maybe $2,000 a month or so to rent a home. It's nearly $3,000 a month to own a home on average in New Jersey. And here's some interesting numbers on our inventory here. We've created about 16,838 new units year over year in New Jersey here. Our net absorption, though, is 19,637 units. So we are absorbing about 3,000 more units per year than we're building. We're just not building it fast enough. What's the effect of that? Rent is up 3%, and some years much more than that. Occupancy is up 96.8% average occupancy here in New Jersey. Employment is up 1.288 million people employed here, 500 new jobs in the last year. Households are up as well, 9,100 new units, new households here in the last year in Jersey. New Jersey is a growing market, despite what you might see on the news or anything like that. It is one of the best markets to invest in here in the entire country. The national home ownership rate is higher than it is in New Jersey. About 62.9% of people own a home in New Jersey. The average rate is about 65% throughout the country. So we have a low homeownership rate here in Jersey because it is so expensive to own a home. It is cheaper to rent. Therefore, more people rent than own in Jersey. And that's good for us landlords. This is an interesting set of data here. Popular Sunbelt areas are really leading in supply growth. The amount of supply hitting the markets in a lot of these Sunbelts is just phenomenal. And New Jersey is not on this list. That's a good thing. We're seeing a ton of supply hit the Austin market, Charlotte, Nashville, Phoenix, Raleigh, Denver, Miami. These markets are getting nailed with supply. Oversupply tends to mean you have a lowering of rental prices and property values. Here in northern New Jersey, we don't see that because it is harder to build. It's slower to build. There's a bit more bureaucracy and red tape. Therefore, less units hit the market at a slower rate. Therefore, we're less likely to be oversupplied as opposed to some of these other markets. So what does undersupply lead to? An increased demand. It leads to a very, very strong rental market. The 2024 U.S. rental market, we're number 3 here in total. Actually in 2025, same thing. We're still number 3 in the entire country, northern New Jersey. Okay, very high occupied amount of units here. 9 renters for each a single unit, and just a large amount of tenants for available units. More qualified applicants than there are available units here in the northern New Jersey market. Here's some case studies on current buildings. Here's an 11 unit we purchased in Paterson, New Jersey. We refinanced it ahead of schedule, about 2.1 years in, returned about 27% annualized return to investors on that refinance. For this building here, then we actually have this building on the market right now. We're fielding offers. Upon sale, we expect to get about a 20% annualized cash-on-cash return to investors. We initially targeted a 10.6% return to investors. We should overperform on this asset. We already are with the refinance. Here's a 6-unit in Passaic, New Jersey. We purchased in 2020. We refinanced 3.2 years into the investment. We returned just under 14% annualized cash-on-cash return to the investor upon the refinance about 3 years in. We initially targeted 11. Then we sold the building in August of 24, and the investor realized about 11.7% annualized cash-on-cash return. We were targeting an 11 for that. We overperformed our target to investors on this building. Here's a 42-unit apartment building we purchased in December of last year in Passaic, New Jersey. This is about 15 minutes away from the current asset in Hackensack. We've already distributed $42,000 to investors since the purchase of this building. We have $1 million renovation budget. We bought it for $7.6 million. We have a 20% annualized IRR to investors and 9.2% target annualized cash on cash as well through cash flow upon stabilization of the asset. And this building here, we target about 81% return of capital upon the refinance. And this is the same thing. We plan to refinance 3 to 4 years into the investment, sell at year 5. Very similar asset, Class C building, older asset. We're repositioning into a Class B building here about 15 minutes from the target property, where we are achieving our targeted goals to investors and distributing some strong returns to investors on this building. Here's a 4-story, 21-unit walk-up in Bayonne, New Jersey. This was PCG Fund 1. This building was purchased in 2023, and we've increased the rent roll 16.6% since acquisition. We are on schedule to exit this building over the next couple of years. We plan to renovate and lease about 75% of the units in this building. We've done about 60% of them so far. We installed all separate mini splits throughout the building. That was a big job, and our goal is to increase rent about 34% on this building over the next couple of years. Just a note here on PCG Fund 2, if you're keeping track of the funds, that was a debt fund. That is a debt fund. Investors invest in the debt fund. They earn a quarterly interest payment between 8 to 11%. That is paying investors as promised their quarterly interest payments out of PCG Fund 2. Here's a 25-unit on Marion Street in Paterson, New Jersey. We actually are selling this asset. We are signing a contract now with a 1031 buyer. We expect to achieve target returns to investors on this asset upon sale. Rent has increased 26% since inception on this building. We'll expect to achieve our targeted goal of a 12% annualized cash-on-cash return to investors through this building, through improved management, renovation of the units, and increased NOI on this building through improved management efficiencies. Here's a 27-unit building in Rahway, New Jersey. We purchased for $2.7 million in December 21. This was a boarding house we converted into an apartment building. We are cash flowing as targeted on this building. We increased the rent roll by almost 68% on this asset. Our project is ahead of schedule and on budget. We plan to refinance this building in 2026 and probably overperform to investors. The cash flow is really churning out nicely on this building to investors right now, and it's a great strategy. Take a boarding house and reposition it into an apartment building, increase the revenue on the building. Great value add strategy for that building. Here's our heat map of transactions completed in New Jersey. About 200 of them are in Essex County. We're very active in Essex County, Bergen County as well, and just the northern New Jersey market there. You can see we've done a little bit in South Jersey also, but for the most part, northern and central Jersey is where we focus our acquisitions. And we've completed 279 transactions together, Seth and I, here in northern New Jersey over the last 11 years. Here's a list of all our syndicated assets, refinanced assets, current holdings, and so on. And if you want a copy of this offering memorandum, you can schedule a call with a member of our team here at People's Capital Group. So that's it for me, Aaron Fragnito, today. Spots are filling up for this opportunity. Again, it's located next to the #1 hospital in New Jersey. We're targeting a 20 IRR, distribution starting from Q1, and we've been doing this over 10 years here in northern New Jersey. So we are practiced in the art of taking mismanaged Class C buildings and repositioning them into Class B buildings, producing revenue, wealth growth, and distributions to our investors continuously throughout that process, and really maximizing the efficiencies and the opportunities we come across here in northern New Jersey, buying these at discounted prices, repositioning them, forcing equity into the building, and harvesting that equity growth over time for our private investors. So if you want to partake in this next opportunity and get in on this off-market deal here in this high-demand market, start earning distributions and get a huge tax write-off for 2025 as well, schedule a call with a member of our team today. We do have more investors than we do opportunities. So these spots generally fill up very quickly. We serve investors on a first come, first served basis. So I encourage you to schedule a call today with a member of our team. We can see if our investment goals align and determine if we can help you build and preserve your wealth through New Jersey real estate. Thank you. Have a great day.